Hello everyone and welcome to Fluent Financial's What You Should Know for the week of May 9th. My name is Mike Lanise and I'm your portfolio manager at Fluent Financial. This past week, U.S. equities suffered another bout of nauseating volatility as the Fed policy and spiking interest rates led to a third straight late week sell-off. Stocks initially jumped on Wednesday after Fed Chair Powell said the FOMC was not considering a 75 basis point rate hike in June, but then plunged into the weekend as investors feared that this may not be true and recessionary effects may occur due to runaway inflation. The NASDAQ Composite and Russell 2000 indices both ended lower than 1%, while the S&P fell fractionally about 0.2%. Sector performance was mixed, but energy soared on the back of strong earnings and higher oil prices. The 10-year Treasury yield, or risk-free rate, surged above 3% for the first time since late 2018, fueled by rapidly tightening monetary policy and a strong labor market. Looking at some economic data from this past week, U.S. manufacturing fell to 55.4 in April, while construction spending was only marginally higher in March. April's job reports came in slightly above expectation, and wages grew, but not fast enough to keep up with inflation. Job openings and workers quitting reached new highs in March, according to the JOLT survey, a situation expected to maintain upward pressure on employee pay. U.S. productivity sank at a 7.5% annual pace in the first quarter, which is the biggest drop in 75 years, as output fell due to supply shortages. Unit labor costs also increased at 11.6% year over year. Finally, the U.S. trade deficit topped $100 billion for the first time, exacerbated by higher prices for oil and other products. Internationally, OPEC Plus agreed to only a small production increase for June, even as the European Union announced plans to ban Russian oil imports within 6 months. Crude oil gained over 6% for the week. Year to date, the Dow Jones is down over 10%, the S&P is down over 14%, the Russell 2000 is down over 19%, and the NASDAQ is down over 23%. Looking to the week ahead, investors remain skeptical that the pace of interest rate increases won't quicken. Even after Powell's meeting comments, the futures market is still pricing in nearly 80% probability of a 75 basis point hike, even after Powell said it was off the table. Those odds may swing after April's inflation data is released this Wednesday, with CPI scheduled, followed by PPI on Thursday. Other U.S. reports this week include the NFIB Small Business Index on Tuesday and May's preliminary consumer sentiment numbers at the end of the week. With regards to peak inflation and where inflation will top out, the PPI Producer Price Index rate has continued to rise, hitting 11.19% last month. It would make sense that if manufacturers can pass those higher costs onto consumers, the CPI, or Consumer Price Index, should also continue to rise. The PPI 10.7% estimate this Thursday is below last month's level, and both CPI and PPI estimates, if met, might show signs that the worst inflation may be behind us. The next question would be, how long will it take for inflation rates to return to some sort of normalcy? We have seen estimates showing rates dropping on average about 3% from their peak inflation levels, approximately 6 months after reaching those levels. If this occurs, it would put us in the 5% inflation range heading into the Christmas season. Feel free to leave comments or questions to this post. Click the like button and share it if you felt that it was informative. Subscribe to our YouTube channel and visit our fluentfinancial.com website for further information. As always, thank you for tuning in to What You Should Know, and have a great week.